The rising price of gold is, in part, just a return to the median. A bear market has persisted for an extremely lengthy period. If you don't look at the cycles that gold has gone through, you might conclude that it's overpriced and that it's in the midst of a bull run. Europe is about to go to war, and the bond market has noticed. One of the effects of war is price inflation. Bonds are worst hit by inflation. Therefore, it is crucial to withdraw from the European debt markets. Therefore, the United States receives a bid, and it's not because American bond markets are great. Hi, I'm Danny, and you're currently viewing Capital Cause. Here on this September 2nd, 2025, I am delighted to host as guests the folks behind the Capitalist Exploits Insider newsletter, my go-to source for financial intelligence. If you're interested in subscribing, I have a special link for you, a $1,000 discount down below. Those two are Brad McFadden and Chris Macintosh. I really appreciate you all making an appearance on the show. No problem at all, Danny. Thank you, Danny. I agree. Yes, folks, we have been discussing this for quite some time. There is a great deal of ground to cover. All right then, let's jump straight in. Tell me, Chris, what do you see? Is it now? Right now, what's really on your radar screen? At the moment, what is it that you find most interesting? Would you say that every investor should be thinking about that? Risk? I would say risk, and there are two clear concerns. We will highlight them, and Brad will talk a lot today, so keep that in mind. No need to speak. Thus, US stocks are vastly overpriced due to the extreme concentration of both risk and capital. What does that look like? We can go over it. Additionally, about Europe, it has long been speculated that they will lead the continent into conflict. This speculation has recently been even more apparent. Additionally, there is talk of reducing certain social commitments in order to prepare for the war, and bonds are currently blowing out across most of the globe, including the UK, France, and so on. All of these things will lead to significant inflation then. Bond markets, and in some cases already overpriced equity markets, are expected to see significant disruption as a result of these. I understand now. Unfortunately, a large section of our audience is headquartered in the West or has some financial holdings in the American or European markets. There is a substantial danger there. Instead, we will be focusing on the alternative today. Additionally, we have historical points to which we might refer. We'll revisit Japan to give you a clearer idea of what it was like there, along with the criteria that determined it and why we think they're vital for understanding our current situation. Yeah, so regarding that news you said, it warns French hospitals to get ready for war in 2026. Does this debt collapse cause war, or does war precede this debt collapse? The two are unrelated. A debt collapse precedes communist authoritarianism, but we've been predicting this for years. It's not because we have crystal balls. Rather, history shows that when nations run out of money, particularly after transitioning from a free market economy that is democratically based to more socialism, the result is always a communist dictatorship. Going to war is one way to, quote-unquote, fix that. All things considered, these have always been readily apparent to anyone who studies history. Now all we can do is watch as they unfold before our eyes. Narratives you hear are thus merely background noise. You should disregard them. They'll point fingers and declare this or that is to blame. Putin is not to blame. In Putin's absence, Iran, South Korea, North Korea, Middle Korea, or any other country would have been chosen. Iraq, Iran, or anything else. Where am I at risk? Should be the primary concern of individuals. Is my money in danger, and maybe even on a personal level? And how can one either prepare for or take advantage of the inevitable? The signs of this are becoming apparent, I see. This debt issue is being exacerbated by the increasing prices of precious metals like gold, silver, and platinum. Silver and platinum were recently added to the essential minerals list by the United States Department of the Interior. Contrary to its Western counterparts, such as Japan and Europe, the US dollar has been rising, while the yields on US Treasury notes maturing between 10 and 30 years have been relatively unchanged. For what reason? An expected sign of a weaker dollar would be a higher gold price. So what's happening? To a certain extent, the recent uptick in gold's price is just a return to a median that has been experiencing a bear market for quite some time. So it's either a lack of historical context or an ignorance of the market's natural cycles that leads one to believe that gold is currently experiencing an overvaluation. However, when it comes to the US bond market, there is a significant amount of money that is tied to fixed income and cannot exist outside of it. That is, all you have to do is hunt around to find a place to put your money if you're a fund manager with a fixed income portfolio. There's no way to express your disapproval of a fixed salary. I intend to convert it into gold, commodities, or some other asset class. Buying bonds on the bond market is your mission. The United States remains the most spotless item in an otherwise unclean pile. Along with that, now that bond markets have figured out that Europe is going to war with inflationary inflation, which is terrible for bonds, investors are fleeing the European debt markets. This means that the US gets a little bit, not because its bond markets are great, but because they're not as bad as Europe's. That the United States appears to have an incentive to prolong the conflict in Ukraine is intriguing. I was going to ask you the same question, Brad. With everything that's happening at the moment, what's on your radar, Brad? As Chris mentioned, and as we discussed before we started recording, is the recent surge in precious metal prices actually due to the price of gold? Is it true that gold is a boom-era commodity? Does the price of precious metals truly seem to be booming, or is it just normalizing? In the United States, interest rates on 10 and 30-year bonds have been steadily declining during the past 40, 50, and 40 years. What a remarkable period it was. When placed in the grand scheme of things, did not constitute anything particularly noteworthy. The question therefore becomes whether we are truly experiencing a bull market or merely retracing our steps after decades of bear markets. As you said before the debt crisis, it's a sluggish move. I wouldn't call it an emergency. In times of crisis, action is typically lightning fast. A collapse in the stock market or something similar. A crisis has occurred. The bond market is moving at a snail's pace. We've had no choice but to hold on to you. Looking at things from a long-term viewpoint can sometimes be helpful. Since around 1980, bond rates, particularly in the US, have been consistently falling, a phenomenon known as a bear market. Identify it. The delight. Regardless of the exact number of years, it will be 45. It doesn't unwind over 550 years, you know. It's far more time-consuming. Consider the bull market and gold, for instance, from a relative vantage point. There's a lot more unwinding to be done, Danny. In my opinion, it's merely a matter of playing catch-up. This market is not yet in a bullish phase. Nothing has been revealed to us so far. Another important consideration is that, to our delight, gold is now playing catch-up. However, for the past 5 to 10 years, we have been wondering why the price of gold isn't higher than $5,000 per ounce, as much as $10,000 per ounce. Strange things have happened and are happening all the time, so it could sound crazy. As a result, you return to the GFC. You could definitely start much earlier, but for the sake of argument, let's say the Great Financial Crisis. Whatever you choose to call it, monetary policy was largely responsible for averting the global financial crisis. Since further stimulus, Operation Twist, or quantitative easing has been met with every minor setback. And it's not limited to the United States, it's global. I mean, China has also been engaging in this. Repetition of stimuli occurs every 2 weeks. Truthfully, it's not like the behavior of central banks has thus been entirely careless. Their easy monetary policy measures have led them to behave as though their actions have no consequences whatsoever. Therefore, we engage in a game of catch-up. And for those who believe that inflation is under control, the process continues thereafter. What a harsh awakening they're in for, in my opinion. Furthermore, this is where a lot of strange things are going to start happening. Things have gone awry due to the low interest rates and extremely easy monetary policy. There is a lot of awakened stuff occurring in the world right now, and I think it's all because of the easy money. When you're in it for the easy money, you can get away with a lot of BS. I guess that's going to be a wake-up call about the renewables stuff. Absolute zero. The extremely low interest rates that have been in place for the past decade or so are to blame for it. Yeah, and in the end, they decided to give up. They are basically pouring all that money into AI regardless of anything, because AI was so effective in tackling the climate change issue. Were we to have invested so much in AI if it weren't for the availability of low-cost financing? It's terrifying in a way. In case you forgot, the United States has been a major exporter of oil and gas since the shale revolution. Energy prices dropped as a result. As a result, the Federal Reserve and other central banks across the world were able to bring interest rates down to zero, thanks to the deflationary effects of this. Well, that's the elephant in the room. It's the main reason behind the surge in renewable energy, the emergence of wokeness, and the astronomical valuations of technology stocks. That becomes irrelevant as soon as that turns around. The rising cost of capital, energy prices, inflation, and discount rates make investing in tech equities less appealing for future earnings. Thus, it is indeed quite intriguing. At the moment, gold is acting like a canary in a coal mine. This is just the beginning. Other global bond markets, including those in Europe and Japan, are also reacting. Danny, everything is turning out just how we expected. Sometimes things just take a little longer to work out the way you had hoped. It is intriguing that you brought up Japan's 30-year yield. That is absolutely soaring at the moment. It was here the last time I checked, I believe. Thus, it is presently at 3.234%. When considering their 30-year yield, this is an all-time high spanning multiple decades. You may remember that we experienced that short yen carry trade unwind about this time last year. Everything because we noticed a tiny dip in the yield. Since then, the yields have increased by a significant amount. Are we in for a repeat performance of last year's yen carry trade, or something comparable? On this one, I'll defer to Chris. Truthfully, I am unsure. I can say with certainty that the debt levels are untenable. It's the Widowmaker trade, and I believe it's an intriguing topic to ask. In relation to Japan, the Widowmaker trade has been around for a long time. Next thing you know, it has evolved to a certain extent. I mean, come on, the argument has always been that the Japanese situation wasn't bad enough to cause it to explode at home. The debt to GDP ratio seemed excessive. Nobody can keep it up. Everything else. But that persisted for an extremely lengthy period. I think it remained that way because of the low bond yields that were outside of Japan's control. Their actions were possible in a setting when bond yields around the world were decreasing. As bond yields around the world begin to rise, what did Japan do first? Issues began to arise for them. That's because money can also look for other options, in my opinion. This has led us to the point where it is, to a certain extent, occurring. Therefore, they are the world's most important markets, among others, and their actions will affect every type of investment. Consequently, you should pay attention to them. However, the issue we are facing is the immense global debt. And then you ask, what will be the outcome? When anything like this happens, what usually happens? In most cases, exorbitant inflation follows the elimination of these debts, which can happen through war, complete default, the creation of money to pay them off, or a mix of these and other strategies. The intriguing thing is that all of those things led to the same economic situation, a stagnating, shaky economy with high inflation due to reductions in numerous commodities and services.